Welcome to my pencast for accounting 1110. The goal of this pencast is to make adjusting entries. First, let me show you the steps of the accounting cycle. We have the steps we learned in Chapter 2, where you journalize transactions, you post to the general ledger, and then you make an unadjusted trial balance. And then we add what we learned in Chapter 3. Chapter 3, we're going to learn how to make adjusting entries in the general journal, then post them to the general ledger, and then make an adjusted trial balance. Same general journal, same general ledger. Trial balance is just account balances pulled off at a point in time to prove the equality of debits and credits. From the adjusted trial balance, you'll be able to make financial statements that have correct account balances. And remember, adjusting entries are required because some of the accounts have incorrect balances on the unadjusted trial balance. Not because you did anything wrong, but because of the passage of time. So in this chapter, you have to be pretty good at Chapter 2 to be able to understand what we're doing in Chapter 3. Adjusting entries are of two types. There are items that are caused by prepaids, or things being paid by us or to us in advance, and they include both prepaid expenses, things we pay in advance, and unearned revenues, things we are paid from our customers in advance. That's one thing they include. And the other is accrued items. And again, sometimes that's accrued expenses, things we have consumed but haven't paid for, and revenue, things we have earned but have not yet been paid for. And these are of accrued items. In my example, I am going to show you how you would have journalized the transaction originally and what it looks like in its general ledger form in its T accounts, and then make the adjusting entry for the above items. By doing this, you'll see what we did originally during the course of the month, what it looked like in the general ledger before we made the adjustments, the adjusting entry. Then I'll go back and post that in the general ledger so you'll see what it looks like after. And we'll start then by working on the prepaid items. We'll write this out of here. I'll do two examples. I want to do two examples because information can be presented to you two different ways. So let's start with prepaid rent. Let's assume that sometime during December, we'll go with December 1st, you prepaid your rent. You prepaid 3 months worth of rent. You paid for December and January and February, and you made this entry: prepaid rent $3,000, cash $3,000. And how does that look in the general ledger? Well, you have set up an account called prepaid rent, and that's going to be posted into or moved into rent expense with the passage of time. It's going to require an adjusting entry. I'll post my entry prepaid rent. You can see I have $3,000 in prepaid rent. What would the adjusting entry be to fix this? Well, when December's come and gone and over, you will have used 1 month's worth of rent. So if you're looking at a picture of this, you have December and January and February, You have paid rent for those 3 months. And I'm telling you, we're now right here at December 31st. And this much has been consumed, and this much has not. So that tells you we need to move out of prepaid rent $2,000 and have we need to move out of prepaid rent $1,000, so $2,000 is left. I've told you how much is left and how much is used. So I will make an entry that says rent expense and prepaid rent, and this is an adjusting entry. It adjusts the balances in prepaid rent and rent expense to be correct, and it's dated the end of the month. Rent expense will be $1,000. That's what we used in December, and prepaid rent will be $1,000. That's how much has been consumed. I'll pulse this now into my accounts, and you can see that I have on the balance sheet prepaid rent left in the amount of $2,000, which is for January and February, and on my income statement I have $1,000 rent expense for the current month, which is correct. This is my adjusting entry, and it's an example of a prepaid expense. Let's do another one. Let's assume on December 1st that you bought some supplies in the amount of $500 and paid cash for them in the amount of $500. In your general ledger account, you'll have supplies, and this will get adjusted into its counterpart on the income statement, supplies expense. Let's post our original entry that was made during the month. And let's further assume that I tell you that I go out and do an inventory at the end of the period, and I discover that I have $100 of supplies left on hand. What is the adjusting entry then to fix this? Well, the adjusting entry will be dated on the last day of the month. All adjusting entries are. And it needs to move the amount into supplies expense and take it out of supplies, the asset. You can tell by looking at my general ledger account that I have $100 left. How do I get from a debit of $500 to a balance of $100? Well, you know that I need to take $400 out of the supplies account and then put it in supplies expense. This will leave my balance of supplies on hand, the asset, at the end of the month at $100, and that is correct. And this will show my supplies expense for the month of January, $400, and that is correct. When it comes to prepaid expenses, you need to know either how much has been consumed or how much is left, and you'll be told one of those numbers. And then it's up to you to figure out what the adjusting entry is. If you know what's been used, that's easy. Just take that out. If you know what's left, make an entry that makes that happen. So this then was an example of prepaid expenses, or two examples. Let's move to prepaid revenue, where we have been paid in advance. Let's assume that during December, somebody gives me some revenue in advance. December 1st again. Somebody pays me $5,000 for work I have not yet completed. Well, I'm not going to say no thank you. Of course I'm going to accept it, and I'm going to put it in an account called unearned revenue. Unearned revenue is a liability. I owe someone $5,000 worth of services. My balance sheet account on the general ledger after the original transaction was journalized is I have a balance in unearned revenue, the liability account, that will turn into revenue on the income statement as I earn it. So as we sit after our original journal entry, our general ledger shows a balance of $5,000 unearned and no revenue. Let's assume further that at 12/31 you were told that you have earned $2,000 of this. Make an entry that shows you have earned $2,000. Well, we know we need to take out of unearned revenue $2,000 and put it into earned revenue, or just revenue, in the amount of $2,000. This is the amount I've earned. So I make the adjusting entry at 12/31, and I take out of unearned the amount that has been earned, and I put it in earned. I have posted that now. How will it look on the adjusted trial balance? I will show I owe someone $3,000 worth of services, and I will show that I have earned $2,000. So I have looked at my two types of prepaids now. I have looked at expenses and unearned. I have looked at the entry where I originally journalized the transaction so you could get a handle on what's in the general ledger. Then I made my adjusting entry and posted it so you could see how the general ledger would look when it was all said and done. Those two items were both prepaid items, and they showed you how I incorporated the idea of adjusting entries for prepaids. I have moved some of my prepaid expenses into the expense category, and I have moved some of my unearned revenue into the earned category. In both cases, cash happened first, as is always the case with the prepaid items. Let's now learn to do adjusting entries for accrued items. Once again, I'm going to show you what my original journal entry was. I journalized, and then I'm going to show you what the general ledger looks like, and then I'm going to show you the adjusting entry. We are working with accrued items, and so what's going to originally be journalized is easy, and that is nothing. Nothing's been originally journalized because nothing's happened yet. No cash has flowed. Let's assume for our first example that I'm going to do wage expense. Wage expense is an easy one most people can relate to. Let's start with a picture. Let's say we have payroll, and payroll is paid every Friday. This is for you, and you earn $1,000 a week studying accounting because it's hard. Let's assume further that December 31st, our current month, is on Wednesday. So Monday and Tuesday and Wednesday have passed us by, and Thursday and Friday have yet to happen. And the payday is on Friday, where you expect to get paid $5,000. There is no original entry because nothing's happened yet. What do I need to do in the adjusting entry category to make my balance sheet right? Well, I owe you $3,000 worth of wage expense as of the end of December, so I will make an adjusting entry at 12/31 that says wage expense and wages payable. I owe you $3,000, so I will make the entry for that amount. Let's see how that looks. First, our balance sheet, wages payable, then our income statement, wage expense. I have nothing set up for this to start with because nothing's happened cash-wise yet. But I will now post the adjusting entry, and wage expense for the month will be $3,000, and wages payable for the month will be $3,000. So cash hasn't happened first, recognitions happened first. Cash will happen later. cash will happen in January. In our example, it would be January 2nd. So what will we journalize on January 2nd? Well, on January 2nd, in the next month, I'll make a journal entry. I need to make that payroll for you. You're expecting cash of $5,000, and you're not going to be happy if I just pay you $3,000. The first thing I need to do is get rid of the wages payable I set up for the first 3 days of the week, because I'm now paying you. And then I'll say wage expense for the other 2, because that belongs in January. So in January, I will make a journal entry. I don't have one set up in advance of this. Cash hasn't happened first, cash happened second. First, I make the adjusting entry on 12/31, and then in January, I'll come and pay it. Paying it in January is often referred to as a subsequent payment, and all accrued expenses need to get paid. So accrued expenses get paid in the subsequent period, and they eliminate the payable you set up, maybe have some expense for the current period, and pay it off. And that is an example of an accrued expense. Now remember, we said we needed to do accrued expenses as well as accrued revenues. So let's move on to the revenue. Our next example then will be to show you an adjusting entry for an accrued revenue. And I'm happy to say this is an easy one. A journal entry hasn't happened yet because there has been no cash. The general ledger accounts that are going to be affected are going to be accounts receivable, I abbreviated that, and revenue. And what's happened is, let's look at our calendar again. Here we have December, and here we have January. Towards the end of January, we did some work for someone, let's say $10,000 worth. And we haven't been paid because we haven't billed them. But on December 31st, we have earned it. It belongs in January. So I will make an adjusting entry dated 12/31, and I say I have accounts receivable for $10,000, and I'll pick up revenue for $10,000. Wahoo, I have earned it. It belongs in December. And so I'll set up that receivable, accounts receivable $10,000, and I'll pick up the revenue. So as of December 31st, I show someone owes me $10,000, and they do. They've done the work, and the revenue's been picked up in the current period. I earned it in December, and it's in December. Sometime in January, I'm going to get paid for this. One would hope, wouldn't you? Let's say on January 10th that my customer paid me. So in January, next month, I'll pick up the cash of $10,000, and it doesn't go into revenue again. It comes out of accounts receivable. I already picked it up as revenue with that adjusting entry. This, too, is a subsequent event. And all accounts receivables, or all accrued revenues that you set up, will be paid in the subsequent period. And you won't take them to revenue again. You'll take them out of the accounts receivable. So, wahoo, we're done. In this example, I shared with you some adjusting entries. To summarize, adjusting entries are made at the end of the month or year. If you're doing a year, they're dated the last day of the period that you're working on, and they are to correct balances in prepaid accounts. There are both expenses to consider and revenues, and they're to set up accrued items, accrued expenses, and accrued revenues. There's one more we haven't talked about, and it's kind of lengthy. It's actually a type of prepaid, but it's a super prepaid, and it's depreciation. Since depreciation is rather lengthy, I'll talk about that on its own pincast.